In this video, we're going to provide a debrief of Task 1 of the second sample assessment for personal tax. So Task 1 is about the principles and rules that underpin tax. So we have a number of parts to Task 1. Let's have a look at the first one. The issue of residence and domicile status is critical when determining if and how an individual is chargeable to UK tax. So in Part A, we need to define the terms residence and domicile. So first of all, with residence, an individual is resident if they meet the statutory residence test rules, and that makes them deemed to be resident. Now, we're not required to explain this in this question, but while we're here, let's just revise this idea of residence. So you can see in the reference material section 6, there's guidance there about residence, and the statutory test is included here. So first of all, we need to think about whether or not the person is automatically not resident. So are they automatically overseas? So you can see there are the criteria. So if they meet those criteria, then they would be automatically not resident. Having done that, we then need to move on to the automatically residence test. And again, we can see there are the criteria for that. And if they meet the automatically resident test, then they would be resident. But if they do not meet either of these tests, then we need to consider whether or not they have sufficient ties with the United Kingdom. And the number of ties they need to meet will depend on how much time they spend in the UK. And we'll come on to that in a little bit later in the question. Then a person is domiciled in the country in which they have their permanent home. So notice that domicile is different from nationality or residence. So a person may be resident in more than one country or have dual nationality. But under UK law, they can be domiciled in only one country at a time, where there is their permanent home. Part 2 of the question says, state how the residence and domicile status of an individual affects their chargeability to UK tax. Probably the best way to go through this is to have a look at the summary diagram that we have in our course materials. So the effect of residence and domicile really depends on the source of income. So we can see on the left-hand side, if we have income from the United Kingdom, then we will be taxed on it. It doesn't matter whether we're resident or domiciled, we will be taxed. So it really depends much more on whether we have foreign income, which we can see on the right-hand side. So if we're receiving income from abroad, if we are both resident and domiciled, then we would be taxed on the arising basis. So it means that all worldwide income and gains are taxed in the UK when they occur. However, if we look at the middle column there, if we are resident but not domiciled, then we have the choice of whether we want to use the arising basis or the remittance basis. And it's quite likely that we're going to use the remittance basis, which means that we'd only pay tax if we bring that income into the United Kingdom. So if we earn that income abroad and it stays abroad, then we don't have to pay the tax on that. And then finally, if we are neither resident nor domiciled, then that foreign income is not taxed in the UK. Let's move on to Part B now. You work in a firm of chartered accountants and a new client, Dr. L, has contacted you to ask if they need to pay UK income tax. You've determined that Dr. L may be resident by ties as he does not meet the automatic UK tests and he has never been deemed resident in previous tax years. So remember, we saw this earlier, that we have these two sets of automatic tests, but if neither of them apply, then we have to deal with the ties. And we need to see whether there are sufficient ties to the UK to be resident. So we need to explain how Dr. L would have his residency status determined. So there's guidance for this in the reference materials. So they would be resident depending on the number of ties. So if UK resident for one or more of the previous 3 tax years, 4 ties would be needed if they spent between 16 and 45 days in the UK, 3 ties if between 46 and 90 days, 2 ties if between 91 and 120. And if they're in the UK for more than 120 days, then only 1 tie would be needed to make them resident. And if they were not a UK resident in the previous 3 tax years, then we can see that we've got some different figures there. So that's all provided in the reference materials. However, what's not included in the reference materials are all the different ties. So that's something that you need to remember for the exam. So let's use this opportunity to remind ourselves of these as well. So there may be a family tie. So this is where we might have a spouse or a civil partner, cohabitee, or a child under 18 that is a UK residence. There may be an accommodation tie. So we have a place to live in the UK that's available for a continuous period of at least 91 days in the tax year. There may be a work tie. So we work in the UK for at least 40 days. There's the 90-day tie, so you spend at least 90 days in the UK, either in both of the 2 tax years immediately preceding the year in the question, or there may be a country tie, so we were in the UK for more days than in any other individual country. Okay, so remember, you need to memorize these to be able to use them in the exam. And finally, part C, you work at a firm of chartered accountants and your manager has noticed that there has been an increase in clients trying to claim private expenses as business expenses. Your manager would like you to start preparing notes for communication to all clients that clearly explains the difference between tax avoidance and tax evasion. So we need to define each of the terms tax avoidance and tax evasion, giving one example of each. So tax avoidance is any legal method of reducing a taxpayer's liability. So typically we would be following the tax legislation, but typically in a way that's not intended by the rules. So we're trying to find some sort of loophole. So it's legal, but not what was planned by the tax legislation. So the question asks us for an example. So an example of that would be, directors receiving their pay in the form of a loan, but never repaying the loan. Another example would be working as a contractor, invoicing the company rather than as an employee, and this would allow the employee to save paying national insurance. And then about tax evasion, so this is an illegal method of seeking to pay less tax than is due by deliberately misleading HMRC. So we could do this perhaps in a couple of ways. We could simply just hide information from HMRC, or possibly just lie to them and provide them with false information. So the question asks us for an example. So here's a couple. So failing to declare income or declaring less income than actually earned. Now this question doesn't ask us about tax planning, but while we're here, let's revise this as well. So tax planning is a legal way to minimize tax payable following the tax law as intended. So there's a couple of examples here as well. So paying money into a private pension scheme, which would allow us to pay less tax, and also making charitable donations. Both of these would allow us to increase our basic rate band and pay less tax at the higher rate.